The stock market is in chaos right now. Stocks are tumbling, investor sentiment is at rock bottom, and the fear is real. We've seen the Nasdaq and the S&P 500 take sharp hits in the past, and much of this panic is being fueled by Trump's newly announced tariffs, bringing back memories of past trade wars that sent markets into a tailspin. But here's the thing, this isn't the first time markets have crashed, and it won't be the last. In today's video, I want to take a step back. I'll walk you through exactly what's going on right now, from the latest headlines to the historical patterns most investors forget about. I'll also share how I'm personally handling this downturn, the mistakes to avoid, and the mindset shifts that can help you come out stronger on the other side. If you're worried, unsure, or just want a clear-headed perspective in the middle of this noise, this video is for you. Welcome to the channel, friends. Today's video is going to be a bit longer. I'm planning to talk about what's been happening recently in the markets, especially the tariffs. I'm going to be speaking about some of the fear in the markets, the previous warning signs, and how to approach the current markets, what I'm doing, and tips going forward. Before going into the video, I do want to say that I don't have a crystal ball. I don't know how far down the markets are going to go, and I don't know how high the markets are going to go in future. So anyone claiming that they know exactly what's going to happen doesn't really know the markets. Even the best investors in the world get things wrong. None of what you see on this channel is financial advice, and everything here is just some of the research I've done and my own opinions as well. So recently, the S&P 500 and other major indices around the world have taken a massive hit, and just to show you how big of a hit some of these indices have taken, here's the S&P 500. Year to date is down 13%. The Nasdaq is down 17%. The Russell is down 18%. The Russell is an ETF of 2,000 US based stocks, and they're mainly smaller cap stocks, so it's not things like Nvidia, etc. It's more of your smaller companies. And the FTSE, the UK market, that's also down 2% year to date. So there's so much red over here, and there's mainly one reason behind it, and that's because of Trump's newly announced tariffs. Initially, when tariffs were being mentioned weeks ago, I didn't really know too much about tariffs, so I had to do a bit of research, and I thought I'll just spend a minute talking about what tariffs actually are. Imagine you have the USA, and a mobile phone is being manufactured in the USA from scratch. All the materials, the wages of the people creating it, etc. In total, let's just say this cost $900. So if an iPhone was to be made in the USA from scratch, let's just put an estimation, $900. If you got another country such as China, for them, because their raw materials are slightly cheaper, or their minimum wage in China is much cheaper, considering all of this, it might cost much less to create an iPhone in China. As an example, let's just say it costs $700 to make a iPhone in China. So you've got an iPhone in the USA that costs $900 to make, and you got one in China which costs $700 to make. So logically, all of the big companies, they'd want their manufacturing to happen in China. And once the manufacturing is done in China, they'll just import it over into the USA, and then they'll charge customers accordingly. So they can charge, for example, $800 and still make $100 in profit. But as a result, who loses out over here? In this situation, the US loses out. Why do they lose out? Because if everything is being imported from China, what's the USA actually doing? They're just selling these to consumers, but they're not actually creating anything. You know, people, they're not in jobs because they're not creating it. The raw materials aren't being used in the USA, etc., because they're just relying too much on other countries at this stage. So what Trump has done is he's essentially announced some tariffs. You can think of tariffs as a tax. And essentially what he's done is he's put tariffs on so many different countries, and with China as an example, he's put a tariff of 34%. Now what that means is this iPhone that's being created in China that costs $700 including everything, it no longer costs $700. When you factor in a 34% tax to import it into the USA, it now costs $938. So now we're in a situation where it's cheaper to create the iPhone in the USA than it is to have it created in China and then imported over into the USA. And the logic for Trump doing something like this is that so more things happen in-house and the US becomes less reliant on other countries. That's the idea. Whether this actually happens or not is down for debate. But in the end, if this situation was to work out, then the US wins. So what's happened is Trump, he's announced these tariffs on pretty much most countries out there. You could see the list over here. If you wanna look at it in more details, feel free to pause it and look into it. But the main ones I've highlighted in red. So China, 34%. Europe, 20%. Vietnam, 46%. UK, 10%. This Vietnam one, companies like Nike, Deckers, etc., they've crashed. They've gone down so much, and the main reason being is because most of their clothing is manufactured in Vietnam, and a 46% tariff on them means that the cost of these things, it will be much more expensive. So that's one of the main reasons why the market has gone down so much. When I seen the fear and greed index at extreme fear at a level of 4, I was thinking to myself, has the markets ever been at this sort of stage before? It'd be interesting to see that. So I tried to find a chart for this, and this is the closest thing I could find. And unfortunately, this only goes back to about 2021. It doesn't go back before that, so I can't really show more than that. And the fear and greed index is currently at 4. And historically, in the last few years, the lowest I've seen is this point over here, which is in 2022 when the fear and greed index hit a level of 3. That's the lowest I've seen it go. Now, what's interesting to see is if I add the S&P 500, which is in red, on top of this fear and greed index, you could see when levels have been at extreme fear, so this low over here, the S&P 500 did eventually go down lower. However, if you did buy there, then you'd still be in profit right now. And likewise, with extreme fear right now, there's a very good chance that markets might go up. But generally speaking, any time you've bought in extreme fear has been a good time to buy, historically speaking. This time, there's no guarantee that things would be different. It's likely that it might be the same situation, but there's also no guarantee that it will bounce over here. Markets might still come down further before it does eventually go back up. The other thing to mention is the volatility index. So this is a chart called the VIX, and essentially when the VIX is high, that means the market is in panic mode, and you could almost treat it the same way as the fear and greed index. So what I'll do is I'll overlay the S&P 500 on top of this, and you could see it's pretty much an inverse relationship, meaning that if the VIX is high, that means the market is low. If the VIX is low, then the market is high. On this chart, in yellow, you've got the chart of the S&P 500, and in this blue color, you've got the VIX. And what it shows you is whenever the VIX has been high, the S&P 500 has been low. So it's an inverse relationship, and generally speaking, the times where the VIX has been high, it's been a good time to buy in the S&P 500. And if I zoom in back over here, you could see in the year 2000 there was this massive peak in the VIX, and that corresponded to a low in the S&P 500. There was another spike over here, and that corresponded to a low in the S&P 500. Over here there was another spike in 2008, and that corresponded to a low in the S&P 500. And you could do this so many times. So again over here, and so on. There's so many times you could do this on the chart. So generally speaking, when the VIX has been high, it's a good time to be buying into the markets because that's when most of the volatility is. Now let's try and understand the fear. The tariffs that Trump announced were much higher than the market expected. The markets were pricing in a 10% tariff, and Trump came out and imposed different tariffs for different countries and 34% tariffs on China. These are much higher than what the market expected, and that's one of the reasons for such a steep sell-off. There's also talks of counter tariffs from other countries. You've got countries such as China saying that it's going to coordinate with Japan and South Korea to bring counter tariffs to the US. The effects of these tariffs at the moment is unknown. Most speculation says it will either reduce the company profits because they're having to pay these tariffs, or the companies will simply just increase the price of their goods, and so general inflation for the general public will increase. And there might also be a combination of both of these factors, where companies' profits will reduce and the cost will also increase. Markets, they don't like uncertainty. They'd rather be told, okay, this is what's exactly happening, there's going to be no negotiation, no countries are retaliating, and this is how it's going to affect company profits. Markets would much rather that than have this sort of uncertainty where Trump is ordering these tariffs and then other countries are giving counter tariffs, and then it's just negotiation here and there. The markets just want an answer. They want to be able to put this to bed and move forward. But even before this, the economy was already unwell. The customer sentiment, the average consumer sentiment was at lows. If you were to speak average American, they'd be talking about how things aren't going well in their country. You know, healthcare's a problem in their country, etc. But even though the job market and all the numbers, the inflation figures and things were improving, this is not translated in the actual consumer sentiment, and that's one of the main things to factor in. And the other thing is the treasury yield curve. Generally speaking, whenever there's an inversion of the treasury yield curve, when it's been negative and then it goes above zero, a recession has followed very soon after. For example, in the late 1960s, you had an inversion of the yield curve and it followed a recession in grey. Soon after that, you had another one over here. 1980s, you had one. 1990s, you had one. In 2000, you had another one. in 2008, the financial crisis, you had an uninversion and then a recession followed. And in COVID, you had one, and then there was the COVID crash and so on. And recently, there was another uninversion. This happened in December last year, 2024. So if history was to follow what's happened in the past, then at some point in the future, there will be a recession. It's hard to say though, whether that's going to be this year, next year, the year after. These things are harder to predict. But the warning sign was there. Furthermore, people, they feel their losses more than their gains. When you go on your portfolio and you see that everything is 10% up, you smile, you feel good about it. But when you go on your portfolio and things are 10% down, then the way your emotion is different. You feel a bit more scared, you feel a bit more panic. So you can only imagine how things are when you're 20, 30% down. And then you've got herd mentality. You've got social media. If you were to go on social media, there's just a whole host of things going on. Like, you know, some people, they're very scared. Some people are saying, oh, we're going to go into depression and things. And we might do. We don't know what the future holds. However, it's important to plan. And there's no point just scrolling through social media endlessly and just bringing a lot of negativity to yourself. There were warnings. A lot of people say that, oh, Trump has crashed the markets. Because of Trump, the markets have gone down. No one else is to blame. It's only the tariffs. But I disagree with that. There were warnings. The yield curve was just one example I showed you right now, where every time the yield curve has uninverted, then it's followed a recession at some point. I know we're not in a recession at the moment, but it does show that, you know, it's important to be a bit conservative at that point. The other warning that I see is news outlets were being very bullish. And if you've been following my channel, I've mentioned a few times to do the opposite of what the news are saying, because the media, they don't always have you at their best interest. We had companies like the Bank of America saying that the S&P 500 will hit $6,666 this year, which clearly didn't happen. We're just over 5,000 at the moment. We're way below their bear case. We had Standard Chartered say that Bitcoin will double and hit 200,000 by the end of 2025, and currently we're at 82k or 83k. The media, they'll say things when they are overly bullish about something. Generally, it's a good idea to do the opposite of what they are saying. So for me, I use these sort of things just to be a bit more conservative because I don't trust the news. You also have influencers on social media being geniuses, and what I mean by this is you have certain accounts where they'll buy a stock, that stock goes up 10-20% in the next few weeks, and they'll say, oh, I told you so, I knew it, you know, if you bought this then you would have made a lot of money. And yeah, whilst they might have made money as a swing trade, it's important to see what price people sell at. Did they sell at that price? You know, if they did, then very good. But what generally happens is a lot of these influencers, they're just there to try and sell a product, and it doesn't work. In the end, you know, when a lot of people are being geniuses where, you know, they're making a lot of correct predictions, where they're claiming that they know so much about the market, that's usually a bad sign, because that means that these people, essentially it's a game between institutions and retail. Generally speaking, it's very hard to compete against the institutions. So when a lot of people are at this stage, it's just a case of being careful. The other warning I see is that stocks, they were at all-time highs. Most of the charts were almost vertical. Like if you look at Nvidia's chart, for example, it's just straight up. Whichever chart you look at, it was very similar. And the other warning was there were huge RSI divergences on long time frames. If you don't know what the RSI is or RSI divergence is, I strongly recommend you watch my video by clicking in the link above. But just showing you examples of what I mean by RSI divergences, you had higher highs being made over here and you had lower lows being created in the RSI. There was a huge divergence, and this is something called a bearish divergence, where you have decreasing RSI and you have increasing stock price. And generally what happens after this, you get some sort of down move, and that's exactly what's happened over here. That's what's happened here. You can look at most of your favorite big stocks and they all had massive RSI divergences, and now it's pretty much caught up. We have the treasury yield curve uninversion, which I went through before this slide, and we also had inflation rates topping. And you might be thinking, why is this a warning? And if I'm honest, I don't know exactly why, but I can show you what a topping inflation rate has done to the market in the past. This is a chart of the S&P 500, and in yellow you've got the US inflation rate, and currently we're at 4.5% inflation rate. Now going back in history, every time the inflation rate has topped, when it starts going down, that's also corresponded to the S&P 500 going down as well. You could see that happening in the year 2000. This also happened in 2008 as well, where you had the inflation rate going up, then it went flat, and then as inflation rate started coming down, the S&P 500 also started coming down. It happened over here as well in 2020. You had the inflation rate going up, it stalled out for a bit, then inflation rate went down, and that's when you had the COVID collapse. Similarly to right now as well, where you had the inflation rate going up, you had it pause, and then as it started coming down, so far the market has been coming down as well. So I don't know the exact reason why, but the inflation rate is directly linked to the price of the S&P 500 like that as well. The point of it is the warning signs were already there. There is a correction or a crash that's due to come. But unfortunately, with human greed, it's very easy to ignore those calls and just carry on investing in whatever speculative things. I do want to say though, it's not all doom and gloom. The markets have seen uncertainty plenty of times before. And the biggest example I want to give for this is COVID. In COVID, in March 2020, literally the whole world closed down. No one was allowed to come outside. All of the shops were closed. There was just so much uncertainty. We just didn't know how bad things are going to get. It felt as though the world was ending at the time, but the market recovered, and it recovered very fast, and it continued going up. Markets have crashed before. COVID, financial crisis, .com, the world wars, it's happened before, but markets have recovered every single time after that. So we got the .com crash over here, and the markets recovered. We got the 2008 financial crisis, the market recovered. We got 2020, the COVID cycle, the market recovered. We got the 2022 bear market, the markets recovered. And then we got the current crash. We don't know how low this is going to go, but if history was to follow, if I zoom out of the S&P 500, since 1871, the overall direction of the S&P 500 has been up. There's been lots of downturns, but it's very important to zoom out and look at the bigger picture, because whilst everything is down right now, overall, the longer term time frame is an uptrend. So then the question comes is, how do you actually approach the crash? What should you be doing? And contrary to what other people are saying, what I am saying is, if you're not invested in markets, then consider getting started. That's the first thing, because times of panic like this is generally a very good time to be buying. If you are in the markets already, then review your portfolio. Go through every single holding you have and ask yourself, would you be buying this stock today? Is this company a quality company? Does this company have a wide moat? Ask yourself these questions, go through each of them, and find out whether it's something that you would buy again or not. Revisit your thesis. Why did you invest in that company? What is it about it? If you have no idea how to analyze stocks, if you know nothing about investing, then don't panic. Invest in ETFs. The work has been done for you. Major indices such as the S&P 500 is just an example. I'm not telling you to invest in the S&P 500. There's many ETFs out there, but even something like the semiconductor ETF, the SMH, something like that, invest in ETFs. Focus on building high quality positions. If you are investing in individual stocks, then make sure they're high quality, wide moat, monopolies in their field, and avoid the noise. Stick to your own strategy and your own plan. Don't get swayed by others. So what am I doing with my portfolio? I spent the last few weeks analyzing my holdings. I asked myself which ones I would hold, which ones I would get rid of, and I identified which stocks to continue building on and which ones to get rid of. I made a watch list of stocks I want to buy, and I started a dynamic DCA in most of them. And just as an example of what a dynamic DCA is, this is the 50-week EMA and this is the 200-week SMA. And if you don't know what EMAs and SMAs are, then click on the link above to see my video explaining what exactly they are and how to get them on. But essentially, what I've been doing is certain stocks, quality stocks such as MasterCard, I've started a DCA position. So I've started a small amount of weekly buys every time it dips below the 20-week moving average. So I'd start buying over here every single week. And then as soon as it reaches the 50-week EMA, when it goes below that, then I'll double the amount that I'm increasing. So as an example, if I'm investing £50 a week whilst the price is below the 20-week moving average, then when it goes down to the 50-week moving average, then I'll increase that to £100 a week. And then when it gets to the 200-week moving average, then I'll double it again. So the idea behind that is, as prices go down lower, I'll be investing more heavy into those companies. And this is just an example of one of the companies that I'm DCAing into. I'm also DCAing into companies such as Nvidia and Google exactly the same way, so based on the moving averages. So Nvidia, I've been dollar cost averaging about a certain amount over here, and then since it went below the 50-week moving average, I've doubled it, and I'm ready to continue dollar cost averaging if it was to continue going down. And if it was to go above these moving averages, then that's fine. It's not an issue. It just means that I stop my dollar cost averaging, because there'll always be opportunities in the market, so I can turn my attention elsewhere. I'm also watching the chart of the SMH, so the semiconductor, before buying larger position in some of the semiconductor stocks. For those that don't know what the SMH is the semiconductor ETF. This is an ETF with most of the major semiconductors. You could see companies like Nvidia make out a large chunk of the SMH. You've also got Taiwan Semiconductor, Broadcom, ASML, Qualcomm, etc. So you could see that most of these companies are part of the ETF. So I'm very closely watching the chart of the SMH, which is this one over here. And although people are saying Nvidia and other semiconductors are very cheap, which I agree with, however, I do feel that there's further downside left over here. I think the SMH is very possible that it hits this 200-week moving average at around $165, which is another 8% downside from here. And I think at that point in some of the semiconductors such as Nvidia, I'd be happy to put in a lump sum and buy a bigger position. Zooming out, generally speaking, the 200-week moving average, if it gets there, has been a very good time to be buying the SMH. So since 2011, it hit the 200-week over here, and it went up 30% since then. Around 2016, it didn't quite get to it from there till the next peak. It was about 148% move. In COVID time, it hit the 200-week moving average, and then the next peak was about 200% away. In 2022 till the current peak, we're talking another 200% week. So generally speaking, the 200-week moving average has been a very good time to buy companies within the SMH. And if you didn't want to invest in individual companies, then just buying the ETF, the SMH, it's been a really good time to buy. So I'm closely watching this chart. And the other thing I'm doing is I'm blocking out the noise. I'm taking out the emotion, and I'm trying to stay level-headed. I'm trying to avoid looking at the news. I'm trying to avoid looking on social media, and I'm trying to stick with my own thesis, my own research, my own ability to do things. And I'm asking myself constantly, would I buy this right now? And it's really important to do these things, because when you ask yourself, would you buy this right now? You might have certain stocks in your portfolio that down a lot. If you have a stock which is down 30%, it needs to go up 43% before you break even. If something is down 50%, it needs to double in price before you break even. So when you have stocks which are down this much, you have three options. The first option is you just leave it there and risk that it might go down further, but also hope that it goes up. Your second option is you buy more of that stock to bring your average price down. So if you're down 50%, but you think that it's a quality company, you might want to buy more of that stock so that your overall loss goes down to about 30% rather than 50%. And then it's easier for you to break even, because the price only just needs to go up 43% rather than 100% before you've broken even. And then your third option is to just take the loss and invest that money elsewhere. If your stock is down, say for example 50%, and you've done your research again into that stock and you think, you know what, I don't think this stock is cheap, I don't think this stock is going to double, then okay, you might think to just take the 50% loss, but then do research elsewhere and invest elsewhere. It's more possible where you're more confident that stock that you're investing in now will go up 100%. So those are your three options generally speaking, and that's exactly what I've been doing. I've identified a few companies which I want to get rid of, and my plan behind it is when the S&P 500 has a little bounce, I expect it to hit some of these moving averages again, and at that point I want to get rid of my less quality holdings, and I'm going to keep and continue building on my more quality holdings. And the reason why I'm not selling now and just waiting for the price to come up a bit more is because I genuinely feel that when things go down, it doesn't just go down in a straight line. It has retraces back to these moving averages. So for example, in 2022, when prices have been coming down, it's always had retraces to the moving averages. You had one over here, you had one over here, and you had one over here. So there were chances to get out, but you didn't have to sell directly at the bottoms. Likewise, in COVID, went straight through the moving average, but in 2018, it came back to the moving average before it continued going down. So I do feel that the markets will at some point come back to these moving averages, and at that point, I'm going to get rid of some of my stocks and keep the quality holdings, and I'm just going to continue building on my quality holdings. Some tips. First thing is control what you can. There is no point focusing on what Trump is doing or worrying about what Trump is doing, or just thinking that, you know, your portfolio is in the hand of Trump. Things that you can control is your position size. How much money are you actually putting into each trade? Are you putting in so much money that you have no money left when prices come down? So that's something you can control. The second thing you can control is your strategy. What's your plan? Is your current plan not working? If it's not working, why is it not working? Is there a different way you can do things? Is there a way where you can just DCA or dynamic DCA? Have a play around with different strategies and see what works best for you. Focus on building high quality positions. Try and invest in companies that have a wide moat and a competitive advantage compared to others, and those will generally be your winners. Shift your mentality and emotion. When other people are being fearful, those are your time to buy. And just one thing I wanted to show you, if you look at the chart of the S&P 500 with the RSI, the weekly chart, I've drawn a horizontal line every time the S&P 500 went to oversold levels according to the RSI. So you could see over here, the RSI went low, RSI was low, RSI was oversold, RSI oversold here as well, and the current price as well where it's oversold. Generally speaking, buying at these prices where RSI has been oversold has been a good time to buy. If you compare it to the current price, it's been a very good entry. Yes, price in the short term, in the next year or so, it continued going down, and if you bought at all three of these points, your average would have been somewhere here in terms of price, and you would have broken even very quickly. Here you could see the markets did continue going down a bit more, but you were very close to the bottom and price continued going up after that. The COVID lows, that's another very good example. That was very quick. You've got the 2022 lows, however that didn't exactly cross the oversold levels, but then you've got the current price as well where it has gone to oversold levels. So looking at certain metrics, it's a very good time to be buying at the moment. Scary times make the biggest wealth, and the RSI is one example that I just showed you. You've got the fear and greed index being at all-time lows being another example. And I'm just going to put a few quotes from Warren Buffett. One of his most famous quotes is, "Be fearful when others are greedy, and be greedy when others are fearful. When the tide goes out, do you discover who's been swimming naked?" So when markets crash like this, you could see who was too overexposed in the markets. And unless you watch your stock holding decline by 50% without becoming panic stricken, you should not be in the market. So the point is, markets, they come down, they don't always go up, and volatility is something that's always been there. The markets generally is recovered every single time. So panic selling your quality holdings at these prices is probably one of the worst things to do. It's very important to have a plan and a strategy and just stick to it, because if your time horizon is 5-10 years, then the markets will recover. They'll move on from these tariffs. We don't know how things will end. I'm very curious to hear what you think of the current markets. What are you doing? Are you buying anything? What are you buying? Please leave a comment below, and if you found this video useful, please like and subscribe.